Volume profile problems. Here's the big ticket, guys. Everything in the market has to do with expensive and cheap price levels. Today's entire focus, if I can teach you one thing that is going to change the way you look at the financial markets for the rest of your career, it's going to be how to understand cheap versus expensive price levels. Why they're cheap, why they're expensive, how the entire world understands them, what they're looking at, why it's like that. And then we'll bridge into high volume and low volume nodes. I think the biggest importance is to understand that low volume pockets reject price, high volume pockets attract price. But it's a coin toss because you never know which way the market's going to go to them or through them. So we're gonna show you that, and we're gonna basically explain how to expect certain things to happen at certain times. Okay. And then also basically having the ability to look at micro volumes. So one of the things that a lot of traders do with volume is they look at it from a macro context, which is absolutely critical. If you are not using volume profile in your trading strategies, you're at a serious disadvantage. Just like I said yesterday, if you're not using order flow, it's like only looking at one side of the equation, okay? So that being said, today I'm going to teach you this stuff. I'm going to show you how to break this down, and we're going to go into more detail with all these things in greater context. Yeah, so Arun's asking, under this category, we'll be able to explain even the fake zones. Yes, we will talk about it, the fake outs and the breakouts and that sort of thing, okay? So I want to ask you guys a couple questions. Can you guys tell me if you are using volume profile or market profile in your trading? Just type a yes if you are, if you're using volume, if you're using volume profile, market profile. Yes. Hey, Bob. Albert. Okay. For those of you in here that are not, type a no. If you are not using volume profile or market profile, type a no. And I want to just gauge how many of you guys are not. Okay. So we've got a lot of yeses, we've got a lot of nos. I want to explain a few things. For those of you that are not, I'm gonna be bold here for a second, and I'm gonna say some things that you may or may not accept, but I'm gonna help you. Trust me, this is to help you. You need to understand it. You must learn it. It is absolutely critical that you understand it. You understand it, and then you apply it to the best of your advantage with whatever strategies or systems you're trading, or simply incorporate it to some extent, because what I'm about to show you is how the industry, the world, looks at the financial markets, okay? And it's not that you cannot do well with other strategies. It's about understanding how to break down the financial markets. And really, that's exactly what we're doing here today. The financial markets is an auction, okay? It's an auction. And that's why it's called auction market theory. Now, there's a concept called statistical analysis, or statistical deviations, if you will. And if you've ever been to a statistics program, or if you've ever studied math or statistics in finance, there's a thing called the bell curve. And normally it looks like this, okay? And you've got 1, 2, 3 standard deviations, okay? Well, that's exactly what volume profile does, or market profile. It just looks at it on the other side of the market. Let's change this out a little bit. Different color, like that, okay? Now, what we do with volume profile is we break down what we consider the value areas. Now, I'm just going to do this super basic. Keep it simple. It doesn't need to be difficult, traders. This is the problem with a lot of things out there, is it doesn't need to be difficult. It just needs to be understood, okay? Now, the value area, I'm just going to put this as the value area high, okay? And this is the value area low, okay? So we're just talking about this right here, okay? When we look at the value area highs and the value area lows, I want to explain what we're doing here. The entire world in order for the institutions, the retail traders, the money managers, the hedge funds, the mom and pop traders over in Asia, the little guys sitting in his house in the US, the Canadian guys trying to get into the futures markets, whatever the case may be, every single trader, if you are to make money in this business, you need to buy something at a lower price and sell it at a higher price. Or if you're a short seller, you need to sell it at a higher price and you need to buy it at a lower price. There is no other equation to making money. If you do not buy low, sell high. If you do not sell high, buy low, you are not making money. It is that simple. That is how trading is done. That is how business is done. Any business in the world makes money like that. That is called a margin. If you are a restaurant owner, you buy steaks for $1 and you sell them for 25. Okay, you have a margin. Okay, same thing with crude oil. You buy it for $1, you sell it for $1.50. You make 50 ticks. Right, same thing. Now, the problem with this is that traders don't understand how to make notice of what's cheap and what's expensive. Traders don't know how to sell things expensive and buy things cheap because they're always using either indicators or they're looking at trend lines or moving averages or Bollingers or RSIs, or even they're using order flow incorrectly. They're using support and resistance incorrectly. And this is why volume can enhance everything that you do, because it breaks down the markets. Okay, if you have no sound, Dirk, you're going to have to log out and log back in. Okay, now let me kind of explain this. Anything at or above the value area high, at or above, is considered expensive. Anything at or below is considered cheap. Okay. The reason volume and market profile were designed, now this isn't me designing this. This is market profile and volume profile strategies were built by institutional traders for institutional strategies for institutional reasons. So if you're a retail trader playing in an institutional world, I think it's really important that we understand what they're looking at so that we can make sense of how to make decisions in their environment, which we are very fortunate to participate with. Let's not lose sight of the fact that if it isn't for the institutions and the big boys playing this game with large money moving around, we wouldn't have volatility, we wouldn't have movement, we wouldn't have a financial market. So the cool part about this is that once we understand what they're doing and why they're doing it, we can participate with a better edge. So let's talk about that for a second. Balanced markets. Let's go in here and talk a bit about this. First of all, it's important to understand that everything inside the value area, okay, this is the value area between here and here. So everything from here to here consists of 70% of the volume of the market. Everything outside of here consists of 30%. We call the middle the noise zone. We call this the noise zone. And the reason we call it the noise zone is because as retail traders, we're looking at things on a micro level. As day traders, even intraday swing traders are looking at things on a micro level compared to a big institution or a fund or a big boy moving money around. Okay? So the reason we call this the noise zone is, let's say Goldman Sachs wants to liquidate $5 million worth of transactions over a 3-day period, and they have an XYZ price to do it at. Well, depending on what their perspective is, that might move the market up and down inside a daily range all day long. They're totally fine with that because they're not trying to get in at certain small spots. They're just trying to get a good fill with large amounts of orders. So that creates movement in the market. That creates movements up, that creates movement down. Sometimes fundamentals will drive it up, sometimes fundamentals will drive it down. But as a retail trader, we need to understand what to expect inside of here. Inside of here, inside of here, inside of here, because this is what we consider noise. Okay? Now, how do we make sense of the noise versus the noise? We don't need to know what's going on or who's doing anything in here. We just need to understand what to expect. We expect the market to be noisy inside here because this is where balance takes place. We talk about balance, okay? When we talk about the concept of balance, the institutions and the big traders want a balanced market. They want an oscillating market. Why do you think the market trades 80% of times oscillating or inside of a range? Can I ask you guys that question? Maybe you guys can answer. Why do you think the institutions want the market trading inside of a range? Brad nailed it. Because then they know what to expect. They also, let me extend on that, Brad. Remember what I said about cheap versus expensive prices? They know what's expensive and what's cheap. So if they know they have a specific fill price that they can liquidate large amounts of orders on, and they can only do it at X price or better, or X price or better, then they're going to participate several times when the market does what they need it to do. For a retail trader, we get stuck in our own thinking saying, oh, they're trending it up. Oh, they're trending it down. No, they're trying to liquidate large amounts of money, and they have an objective. That objective is to understand the auction and know where to buy things cheap and where to sell things expensive. When the market is trending, they can't decide what's cheap or expensive because nobody in the world can ascertain expensive versus cheap because nobody knows the business area. Nobody knows balance. Why do you think when a market trends lower and then consolidates, it stays there for a while? Why do you think when the market goes up and consolidates, it stays there for a while? Or when the market just stays in a range, it stays there for a while. If you ever look at a market and you ascertain the time it spends here or here versus here or here, you're spending 80% of your time here, 20% of your time here. Does everybody else have sound? I just put in there, log out and log in if you don't have sound, okay? So the reason I'm explaining it like this is because as a professional trader, we need to be able to understand cheap versus expensive and when the market's balanced or not, so that we know how to break down the auction. Okay? We know how to break down the auction. Now, that's not a strategy yet. I haven't told you where to be buying, where to be selling, how to be buying, how to be selling. But I want to explain the difference between day 1, day 2, day 3, day 4. Let's say we're on current day here. This is today. We don't know what's going to happen today. It could do anything. But we know yesterday's range was here to here. And the day before that, the range was here to here. Maybe we got one more day and the range was down here to here. So every day we know that the market moved up, then it moved up a little bit more. And today we're still trying to figure out what's happening. Okay. 80% of the time, we're going to stay within a base point, we're going to stay within a large percentage of the prior day's auction, because the big traders can ascertain what was cheap and what was expensive the day before. Everybody knows what happened yesterday, so they can see the top and the bottom of the range. That helps traders, big traders especially, understand what to expect. And that's the concept that I want to break home about, which is called the inside day versus outside day. An inside day, all that means is that we're trading inside yesterday's range. An outside day means we're breaking outside of yesterday's range, and that's normally when the market is not in balance. On trend days, the market's not doing this. The market's trying to find where it wants to trade and then do that. Or the market wants to go here and then do that. So the whole concept of the auction theory is we need a standard deviation, which is why we call it auction market theory, because it has a reason around statistical analysis. And then what it does is it helps us break down the daily price range. It helps us. Now, this can be done on a micro level, a macro level, but normally you want to be doing it on a level where you can actually understand the daily auction as it's unfolding. Okay. Now, the only difference here between static versus developing profiles is static levels are what's happening in real time. Developing profiles are as the market was unfolding, because value areas move, value area highs and lows move, point of controls move, right? And what this means, so if you're wondering what that is, value area high is this line here, value area low is here, the VWAP is here, the point of control is here. The thing about that is that they're not always at that level. So in hindsight, it looks real good here. In hindsight, it looks real good there, but that doesn't necessarily mean that's where it was during the day. And that's the difference between our software and everyone else's, is we've built internal ways to be able to backtest volume levels so you can go back and actually see how the volume unfolded. What I'd like to do is I'd like to go into the charts and explain some of this stuff. Okay, we're going to just use the profiler version of the software today. Okay, and we're going to go like this, and I'm going to turn some things off. Okay. Go in here, turn the signals off, and just do this. Okay. Now I want you to do so. I want you to know that I'm using the platform Ninja as it's our primary platform. Okay. But I want to go in here and just add another day to this. Maybe I'll just add 3 days. And I'm looking at crude oil for this example. I'm just going to add a couple more days to this mix. So give it a sec here. It's going to load 4 days because I want to show you 4 different days. Let's do this, and let's do this. Should be able to get 4 days. Reload historical. Load historical data, and what I'm going to do is I'm going to show you, okay, I'm going to show you the way in which you can set up, okay, how to understand that. Let's go in here to the data series. And I'm going to go in here and show you the break lines so you can take a look at each day. Okay. And inside of the platform, we have what we call open, high, low, close indicator. It's a platform indicator. It can come with any platform. I'm assuming if you're using other platforms, you're able to see this. Prior day, open, high, low, and close. Now I have the open set to transparent, and I have the close set to transparent. The reason for that is I only want to pay attention to the prior high and low of the range, the auction. I only want to pay attention to yesterday's auction. Okay. Why do you think that is? Why do you think that is? I answered it earlier. This red line and this blue line is yesterday's low and yesterday's high. The market traded here to here, all the way up. That's the auction. This was the most expensive price, and this was the cheapest price. That's where they were able to get the market to, and that's where the market stopped. Okay? So if we think in today's trading, what is the goal of today? The number one goal for today is to be able to first understand what is cheap versus expensive. It doesn't matter what strategy you're trading. It doesn't matter if you're scalping for 5 ticks or you're swing trading for 50. You still need to understand how to buy something low and sell something high. So the best way to do this is to look at the auction to see the condition in which we're trading. 80% of the time, we are going to be trading inside the prior day's auction. So if we come into today and we're like this, let's just bring this over and just like that, okay? So the market opens here, boom. And we just have this little line up here. It's hard to see, but it's there, okay? We know that we're trading inside the auction. So there's an 80% chance they want to keep it between here and here today. There's an 80% chance of that. Now let's kind of break this down and explain why. Because of the bell curve. The daily bell curve. That was yesterday's high. And that was yesterday's low. And that is the mean of yesterday's range. So, knowing that, if we just put a little dotted line in sand up here, right? Just thinking about it statistically, things up here are cheap and things down here are actually, that's expensive, and down here are cheap, okay? So if we open up inside of yesterday's range, there's a 20% chance we'll break outside of it. There's an 80% chance they're going to trade inside of it. What happens on inside days? Price normally wants to revert back to the mean. Revert back to the mean because that's what statistical mathematics has proven over time. So if we're going to go into today's trading climate and think about what's most likely to happen, most likely it's going to come back to some extent if we're trading up there. They're going to try to keep it inside the range. They want to revert it back to the mean. So if we go in and take a look at what happened today, they did that. They kept it down. They brought it back. And they got it back up, and they brought it back again. Why is that? Because once we start to prove that we're staying inside that range, guess what? A new distribution forms for the day. Expensive versus cheap. Reversal strategies work best on inside days. Trend strategies work best on outside days. If the market were to break outside of this range, that's when you want to start using a trend strategy. The likelihood of it trending is there. On days where the market is inside the range, the reversion to the mean is likely so. So therefore, any reversals at expensive price levels or any buys at cheap price levels are likely to revert back to the mean. That's why we use reversal strategies on oscillating days and trend strategies on trend days. See how they kept it inside of a range all day? I don't make this stuff up. I study statistical analysis, and everybody else that understands volume profile or market profile does the same thing. Okay. Anybody that knows how to use it effectively will use the same concept. Now, if we go back, okay, and I go in here and I take a look at this market and I turn on profiles, okay, that's what we're doing here. Let's just use this example. That's yesterday's statistical average, statistical deviation, standard deviation, or distribution, we call it. Okay, that's today's. Once they showed us that they were going to sell and then hold it here, this profile would form. And then when they bring it back up to here, we're expensive. And because we're trading inside yesterday's range, the likelihood of them bringing it back down to cheap is very good. The likelihood of them bringing it all the way back up to expensive is very good because we're on an inside day. 80% of the time, that's going to happen. The only caveat, the only time we can expect things to go outside the norm is on what? What do you think would basically negate this? What do you think could change this from happening? And this is true for any trading system, for any strategy, for any condition. Rick says news. Rick nailed it. When news happens, excuse me, when news takes place, what's actually taking place is fundamental analysis kicks in, and it drives prices from point A to point B. And then guess what happens? They stop it and they go here. So just think of this, these big extensions, news, we call them range extensions because we're taking the market from one place and it's going to another. It's changing the range. It's changing where it wants to find balance. This is an imbalanced market when it's trading from one point to another. This is a balanced market. This is a balanced market. The institutions and me and every other trader wants to know balance. We need to know balance. If you're scalping and you're scalping for a small stop loss and you're trying to scalp reversals, or you're trying to trade directional strategies on small time frames, it's really good to know that if you're scalping on a small time frame, what's going to happen down here, what to expect down there. If you're up here, you should know what to expect up here. In here, anything is fair game. It could do anything because it's the noise. Okay. So before I go any further, does everybody understand what I've explained? Give me a yes if this makes sense to you, if you're learning something from it. Okay. Inside our software, we have what we call developing profiles and static profiles. So what I'm going to do is I'm going to show you a couple features for a second. I'm going to turn the profiles off. Inside our software, what we do is we've created a profile breakdown that allows you to run daily profiles, or you can break them down into time intervals. 30 minutes, 60 minutes, 120 minutes. So I got it on day. So if I turn it on here, you're going to see the daily auction. If I change this to time, it opens up these settings, and I can say it starts at 9 off the open, 9:30. Since we're looking at crude, let's put it at 9. Oh, right here. Okay. And we'll do 30 minutes. We're going to calculate 30-minute price. Whoa, look what just happened. Turn the labels off. Okay. And extend it out. These are 30-minute profiles. You say, how do you trade that? I'm not here to show you how to trade that. I'm here to show you that this is what software can do to help your analysis, because I don't trade it this way. I want to show you how this works. You could do this on 60-minute files. Okay, depends on your time frame and your perspective. You're gonna have less data, easier to read. Okay, let's say you want 1 minute you want 2-hour profiles or hourly profiles, right? Yeah, let's do this here. Start time. There it is. Okay, you can see it's starting to get a little bit less, right? Now, what's interesting is you can see value areas inside of these areas, right? So let's say you're a scalper and you're trying to scalp value. And you know you're not trading the daily auction, but you're trading smaller time frame auctions, okay? Well, isn't that the same thing that I just said here? Distribution, 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 distribution. It's just looking at it from a smaller lens, right? It's looking at it from a smaller lens. Now, is that a strategy? It really depends on your outlook. It really depends on how you choose to trade it, okay? The way I like to look at trading strategies on a micro profile like this is if we have value areas shifting outside of each other. So let me give you an example, okay? Directional strategies or non-directional strategies, it really depends. And I'll explain what I mean by that. You have a value area on a smaller time frame like this. Okay, so that's just the value area. So that's the value area high. So let's pretend that's this one here. Okay, and then we've got the value area low, which let's just put that one right here. Okay, and if we know, so this is the fun part. This is the real fun part for me. Okay, let me just delete this for you guys, show you a few things here. Okay, remember we know that we have a daily auction that's extending like this across the entire day. Okay, just not lose sight of that. But then we know that we've got these minor auctions inside of each other. So let's say we've got an auction right here and we're at the top of the range. Okay, and we've got a value area here and a value area here. And we know that the value area low is here. Okay, and the value area high is here for the top, right? So I'm trying to help you understand micro to macro volume movements, if you will. Now I'm going to show you some actionable strategies in a moment. We're going to go into other details, but I really want you to see how things unfold for a second and how you can understand how to play volume. If we know that they're in a daily range for the day and it's expensive and it's cheap and we're up here and we know that they're in a daily auction and we know that they're going to try to drive it down here and then they're going to try to drive it back up. Right? That's how they do things. That's what range trading is. Well, if you're here and this is a value area up here, remember I said we're looking at two different value areas? So let's pretend, same example, here to here, that's this and this. And we know that we get a breakout like this, okay? And then we have a value area high here. And we know that they're going to drive it down here. This is the pullback, guys, for the trend trades inside to ride it back down. That's how you look at this. Same thing happened here. If the market breaks up, see there's a value high there. And the market broke up, there's the value low. That's the pullback to the trend trade. That's how trend trading is done on a micro time frame inside of daily ranges. Now, you ask me, Sean, is this something that you would trade yourself? I say, well, I personally don't like to trade such small perspectives like this because there's a lot of noise. I like to look at it from a little bit of a bigger perspective. I just simply want to show you that the software has the ability for you to go into micro or macro breakdowns. I would much rather understand the daily auction because it's stronger It's larger, and it gives us more evidence of what's taking place because it's a bigger profile and there's a lot less noise. But there's a lot of traders in here, and some traders like to scalp for 5 ticks. Some traders like to trade for 15 to 20. It really depends on your preference. For me, this is a 10 range chart, and in small ranges like this, okay, in small ranges like this, you can make a lot of really accurate decisions on a daily profile like that. Now, one other feature that I forgot to mention is what we call the developing profile. Now, there's other graphics, like you can change this to numbers and you can do all this fun stuff. You want to, you want it to have it on the right. You want to turn the past profiles on. You want all that. You want to extend labels. I mean, the way we design tools is for you to use it for very good UI. Interface is easy and flexible. But one thing I want to mention is that that is not the way the market looked here. That is not the way the market looked here at the time. So when you ask me, Sean, can you backtest strategies? Most software out there, you cannot do that with volume. They always look at current levels. One of the things that I did when we built the product and we designed it is so that traders that like to backtest, okay, the way that we've done this is we've built what we call developing profiles. Now I'm going to turn this off for a second. This is the developing profile. And the difference between a developing profile is it shows you where the levels were in real time. And this is super, super awesome because what it allows you to do is it allows you to go back and not cherry pick woulda, coulda, shoulda trades. It gives you the flexibility to actually see where the true value area low was at the time, where the true value high was. So when we go into the developing profiles, let's just turn the extreme levels off. And let's just do that. This is exactly where, this is what the profile would look like. So if you see this, let's go here, right there, point of control. That's the value area right here. That is the shift in value as the day unfolded. So as you can tell that what I'm explaining is not inaccurate. They take it to the top, they bring it down to the bottom. They bring it back up to the top, they bring it to the bottom. Now you're saying, well, what about this grind down here? Well, we don't know the gauge of institutional equity movements, right? We don't really know what their liquidity goals are. All we know is that when we get down here, it's cheap. When it's up here, it's expensive. So every time it gets up here, it's expensive, it's cheap. It's expensive. See this little grind up here, but it's still expensive. So we never know if it's going to be 6 ticks expensive, 12 ticks expensive, 15, 4. All we have to always think is that from a statistical deviation in volume, anytime we get up here, it's expensive and cheap. Do we know if it's going to go up to the tick and drop down or 15 ticks and drop down? All we need to know is that everybody in the world knows that once it's up here, the market's expensive. So what should you be thinking as a professional traders? We buy low, we sell high. We sell high, we buy low. So when we're up here, you should never be looking to engage in buy strategies. It's a losing battle long term. The likelihood of the market trading up in that direction, 20%. Do you really want to stack your odds in a trend continuation with a 20% odds of the market continuing? Not unless we're outside day. So the reason I'm giving you these golden nuggets is because a lot of times traders want to trade trends in the wrong conditions when they should be trading reversals. And then when you try to trade reversals, they should be trading trends. So golden nugget number one. Golden nugget number one. 80% of the time, you're in what we call an inside day. Look to fade reversals back to the mean. 20% of the time, you're going to be an outside day. Look to trade trends for continuations because the market's going to try to find balance. In a situation like today, this is yesterday's high of day. We opened up inside of it, and we never traded above it. We tried, and this is what we call a fake out breakout. A fake out breakout is when we try to break outside the range and they can't. The reason we don't break outside the range is because there's an 80% chance it won't. The only way it's going to break outside the range is if major news catalysts drive prices from point A to point B. Does everybody understand that? Lots of information, guys, and I know I'm throwing it at you. Let's talk a little bit about the differences between high volume and low volume, okay? Inside of these scenarios, you're going to have what we call high volume pockets and low volume pockets, okay? Let's just draw a little trusty old magnet here, right? Let's pretend that's a magnet, okay? And we've got some coins over here made of nickel or some metal, right? That's going to want to go there if the magnet's pulling it in, okay? The magnet is where lots of traders have facilitated trade. The reason the market wants to go to where there's a magnet is because they can liquidate and exchange positions. So when you see a profile that looks like this, okay, pretend that that's the magnet, that's the magnet, that's the magnet, and that's the magnet. 1, 2, 3, 4. There's 4 places in this example that I've just drawn that the market will be able to exchange more liquidity because it's proven that that's where price can exchange volume. That's where markets will trade longer. So in situations like this, there's a magnet here, there's a magnet here, there's a magnet here, okay? So think about how often price traded in this range right here. Okay, so just look at how many times orders were liquidated here. Same thing here. There's price was trading through here, okay? Now, I want you to think about what's going to happen here. There's 2 things. It's called a pass-through or rejection. Now, a lot of trading strategies that I've seen in the space, some traders will trade low volume nodes. Now I'm going to tell you my perspective, and it's my perspective. You guys can take your own truth to this and understand it and look at charts. But there's a 50-50 chance that either one of these could happen. So let me explain what that means. There's a 50-50 chance that this is either going to reject from here or trade through it to the next area. There's a 50-50 chance it can go either way. There's a 50-50 chance that it could reject from here or go through it to the next area. There's a 50-50 chance it could go here, 50-50 chance it could go here. Why? Low volume node, low volume node, low volume node, low volume node. What happens at low volume nodes? Low volume nodes are where price did not trade because the market did not accept trade at those areas. Why do you think the market did not stay there for a long period of time? Because nobody was willing to do business. When no one's willing to do business at those price levels, the market doesn't stay there. There's no liquidity. So what we do is we have to think about what to expect the market to do, okay, versus what you should be doing. Now, this is where we get to talk about a concept of confluence. Maybe you have a supply zone here, or a Fibonacci level here, or a pivot level resistance, or a $50 round number. And we know that there's low volume at the same place. We should be able to expect a reaction from here rather than a pass-through. That's the aha moment, and it's called confluence, okay? I'm a big component of confluence. Confluence is a huge deal to me. It's no different than if this is the value area. This is also the value area high. Take a look at this, right? That's the value high. That's the value area low. So if you know you've got a low volume pocket sitting right at cheap prices, if you've got a low volume pocket sitting at expensive prices, what's the likelihood? Forget this stuff here. Let's talk about low volume and high volume outside. Don't worry about all this stuff. The noise zone. Remember we said we can't really gauge what's going to happen here. What about out here? And what about down here? Isn't that where we can really expect to add probabilities to what we're doing in understanding the market? Okay, exactly. And it's also known after the fact, right? And one of the reasons why we don't want to just rely on high volume and low volume nodes for the actual strategy is because on current day trading environments, it could be changing. Different story looking at yesterday's markets, right? Yesterday's markets, low volume and high volume pockets are known to us. Today's markets, they're not. So let's keep this real simple. Value area high, value area low. Distribution, we talk about this. Cheap, expensive. We're not going to worry about anything here, here, or here, because that's what, guys? The noise zone. Low volume pockets here, low volume pockets here. What happens when price got to the low volume pocket when it was cheap? What happened when it got to the high volume pocket when it was expensive? I don't make this stuff up. If you look at any given chart, you're going to see this stuff. Remember I talked about 80-20. When do you think this applies? Do you think this type of information would be good on this scenario or that scenario? You guys tell me. This is where I get to test you. When do you think this type of information is applicable? Exactly, Spike. In oscillating conditions, because that's when expensive and cheap prices are respected by the institutional flow of money. The market is going to respect that. On trending days, anything can happen. We don't know how. The great example was today. Now, today was an exception. Post FOMC, okay, post FOMC announcements, and the range was so large from yesterday's environments that we it was a very difficult day for any type of merit. And we'll take a look at that in a second, but I just want to explain this, how to expect price to react in those areas, okay? Now let's go and take a look at some charts. Let's go here and show this. Let's take the developing profile off. Let's put the composite on. And let's go in here. I don't want to pay attention to the low volume pockets of today's profile. Okay, I'm going to turn these off. current profile off. I want to basically pay attention to yesterday's profile because they're static. So I'm going to draw a little line in the sand, if you will. Let's turn the label off. Just like that. We're going to just draw low volume pockets. I look at what's really evident. So when I say low volume, I don't mean every little dip. I mean the evidence. This is a high volume pocket, low volume pocket, high volume pocket, low volume pocket, high volume pocket, low volume pocket, okay? I'm not talking about every little nook and cranny in here. So if I know that there's low volume from yesterday here, low volume yesterday here, low volume yesterday here, okay? And we're not talking about the extremes. Nobody knows what happened here or here unless you go back a prior day. You can't ascertain this being low volume up here because that's the edge of the entire distribution. We don't know what they would do at the outside edges. So here's what's going to happen. We're going to draw a little line in the sand at the edge of these areas. That's a low volume zone. Low volume zone. Could probably bring it here. We'll bring it there. Okay. And we'll just do here. Low volume zone. Low volume zone. Okay. Does everybody understand why I'm doing this? I want to show you what to expect the next day. So today, this is yesterday's price action. I'm going to just draw this out. Let's go through it. You guys see what I'm talking about here? Before we got there, you should be able to understand what the market should be doing at that level. Does everybody see that? So if we were opening up on crude oil and price came down, we don't know yet what they're going to do. We don't know if they're going to bring it all the way back. All we know is we should get a reaction here. We should be getting a reaction here. And what is the reaction? The reaction should be rejection or pass through. If they reject it, they're going to come in and reject it out. Then guess what that does? That sets our daily auction. Very low, very high. Okay. Now wait a second here. Let's do this. What if they didn't reject it? What if they came through and they passed through? Remember, there's a 50-50 chance. What if they didn't want to keep prices rejected there? What if they wanted to bring it down here? What if they kept it here and then they rejected it here? That would extend our daily auction. Then we would know what's cheap and what's expensive. This is how you go about understanding how to read the financial markets. Not so much, hey, where's my entry, where's my stop? The number one reason traders can't make money is because they don't have market context locked down first before they implement their strategy. If you have a good sense on market context, you'll be a lot more passively able to control yourself. You'll be able to understand what to expect the market to do. So when the market reversed the first time out of that area, I mean, it came down within one tick here, so it's pretty close. But you can see that there's a range here forming. So when it came into this area, you can see where the market reacts out of it. Does everybody, can you see that as being really advantageous? So let's give you an example of how to take this for tomorrow's price action. Okay, let's just take crude oil for a second, and I'm going to show you how you can mark up your charts using the Print Profiler software today, just going in to identify tomorrow's price action. The markets are closed, okay? So let's turn on current day profiles. Let's go in here and go to current levels on. Current profile on. Okay. And we can go historical levels on as well. And if we know the market's going to do this, we know that we still got low volume pockets here and here. So if we just draw those out again, we got a low volume pocket here. Okay. We also have a low volume pocket here. Okay. But we also have low volume here and here. So if we go up, we also have low volume here. We'll just bring this in a little bit. Low volume there. And we also have low volume here. Okay, that's from yesterday's range. So if we open up today, we should know what to expect at these areas. A rejection or a pass-through. On the sign of a rejection, it will help form the distribution. The first sign of a rejection will help you form where the market will keep its trading range. If it passes through, it's called a range extension. It'll give you an opportunity to see the difference. Let's say they kept it in this range. Let's say the market opened here. Let's just say you get the set. And let's say it opened up and it traded in here and whoop. And then they rejected it. And they didn't want it and they pass it through and they get whoop. And then they bring it back up. Okay, what if they do that? Guess what that does? It forms a distribution. You'll then know what they're doing. You'll know where they're keeping it. You'll know how to read what they're doing. The only way to see this is by using volume software to be able to tell you that. Okay, that's why I like to talk about low volume versus high volume nodes. You could do this every night pre-market, just going in and mark out the next areas for you to be able to know what to expect. So then tomorrow, when the market trades into those areas, there should be no confusion. Okay.